And so Chapter 8 discusses changes in parent investor ownership interest. Topics will include accounting and consolidation procedures for interim acquisitions of stock, that is, stock purchases made sometime during the operating year, piecemeal acquisitions of controlling interest, that is, continuous acquisitions of incremental shares of ownership until you reach a controlling interest status, and then sales of ownership interest and changes in ownership interest through investee stock issuance and treasury stock transactions. Previous chapters illustrated consolidations for subsidiary acquisitions at the beginning of accounting period. When the parent acquires a subsidiary during an accounting period, some adjustments must be made to account for the income of the subsidiary that was earned prior to the acquisition and included in the purchase price. And so Chapter 8 is intended to help us think through those different ownership changes and those different ownership interests and how we account for those. So the objectives here are to help prepare consolidated statements when the parent's ownership percentage increases or decreases during the reporting period, apply consolidated procedures to interim or mid-year acquisitions, and to record subsidiary investee stock issuances and treasury stock transactions, which may change or cause there to be a change in the parent company's ownership interest. And so first, let's talk about changes in the ownership percentage. And so changes in a parent ownership could result in an increase where the parent acquires or maintains control, or a decrease where they maintain or lose control. And increases could happen through the parent acquiring a controlling interest during the interim period, so mid-year or a quarter of the way through the year the parent acquires the controlling interest. The parent could acquire the controlling interest in stages, so they buy 20% in one stock purchase, they buy 20% in another stock purchase, and they buy 15% in another stock purchase, so that at the end of that cycle of purchases, they then have 55% or greater than 50%, so a controlling interest. Or they may acquire additional shares from the non-controlling interest, which give them the controlling interest. They could also decrease their controlling interest by selling shares, although because of other situations, whether it's reliance on capital or some other reason, the parent could sell the shares but still maintain control, or they could sell the shares and give up the control. And so again, these are just examples of how there could be changes in the parent ownership. And so what we see where we have an interim acquisition of control, where the parent obtains control, we have to, as we discussed in previous chapters, determine the implied value and allocate the excess. And then after we perform that analysis, we apply our consolidation procedures. And you recall from Chapter 4, where we walked through several examples of those consolidation procedures with respect to work papers and getting to consolidated financial statements. And so here what we're talking about is where an interim acquisition where control is maintained. So the parent increases its share by buying more stock or decreases its sale by selling some stock, but still maintain control even though its share ownership has changed. And here we account for that by recognizing a change in the investment in subsidiary based on the underlying fair value of the equity, and we recognize that no gain or loss is recognized, only paid in capital is adjusted. And so in this interim sale, we are talking about where the parent relinquishes control. So the parent sells part of its investment and no longer maintains control. And to account for that, we reduce the investment based on the proportion of the interest sold. We record a gain or a loss on the sale because we did sell an investment. And then we also discontinue consolidation because if we no longer have controlling interest, we no longer would consolidate the activities of that no longer subsidiary with the parent company's results. And so the question becomes one, is there a gain or a loss? And the basic rule is that no gain or loss is recorded on the equity transaction with the firm's owner. And there are a couple instances here. So in instance one, where control before and after the transaction is an equity transaction. So where we have control before and after the transaction, there is no gain or loss, and we adjust the paid-in capital if needed. If we have no control before but control after the transaction, that's the point of the business acquisition. So we have no loss, but we might have a gain on a bargain purchase, which we talked about in one of our earlier chapters, you'll recall. And then we talk about the issue where there's control before and no control after. We are really selling an asset, a subsidiary, an ownership interest in a subsidiary, and so we have to record the disposition of an asset, and then based on what we pay for that asset versus what we sold it for, we may have a gain or a loss that we have to record. And so those are really the basic rules around those three different types of subsequent transactions or interim transactions. They could be piecemeal transactions, but when we're talking about how we account for those are the general types of transactions we're accounting for, and whether or not a gain or a loss and the recognition thereof would be involved. And so we can eliminate pre-acquisition earnings from consolidated income by either of two methods. We could exclude the revenues and the expenses of the subsidiary prior to the acquisition from consolidated revenues and expenses, or we could include the revenue and expenses of the subsidiary in the consolidated income statement for the full year and deduct pre-acquisition income as a separate item. And what we're talking about here is, suppose I have a company that's been operating from January through June, and we buy the company and buy a controlling interest in it so that it needs to be consolidated, but we don't discontinue the company, we don't dissolve the company continues on, and so it has earnings from January through June, which are pre-acquisition earnings, and then it has July through December on a calendar year, July through December, which would need to be fully consolidated with our earnings. And this talks about the two methods by which we would handle or available to us for handling that situation. And so where we have these pre-acquisition earnings, on the date of the acquisition, we have to calculate an equity book value in order to book the transaction. And in order to do that, we start with the beginning book value of the equity plus pre-acquisition revenues, less pre-acquisition expenses, less pre-acquisition dividends that would be declared to get to a book value equity at acquisitions. And so sales and expenses, but not dividends for the year, may be an assumed level. And so now we want to talk about this idea of interim acquisitions or piecemeal acquisitions. A corporation may acquire an interest in another corporation in a series of separate stock purchases over a period of time. These piecemeal acquisitions require the previously held investment to be remeasured at fair value at the date control of the subsidiary is obtained. Piecemeal acquisitions increase the details of computing investment income and consolidated net income. And so let's walk through an example of this where POD acquired SAP in a series of acquisitions resulting in a total of 90% ownership, and we're given the transaction dates here where on April 1st they acquired a 5% interest at $7 million. These are in thousands. On July 1, another 5% interest at $8 million, and October 1, an 80% interest at $210 million, to give them a 90% interest in SAP of $225 million. The total book value and fair value of SAP's net assets on October 1, that is the date that control was acquired, was $220 million. And so what we can see is that if we paid $225 million for a 90% interest in SAP, the implied book value would be not 250 million, that is 225 million divided by 0.9. The book value we're told was 220 million, so we pay 30 million more than the book value, which gives us a $30 million goodwill calculation. And so if we look at what we're provided here, we're told that SAP's income allocation for the year, so total income was 150 million, total expenses was 110 million, to result in net income of 40 million. From October 1 through December 31st, CI's, or the controlling interest, 90% share of these amounts were 33.7 million for the controlling interest and 3,750,000 for the non-controlling interest, and that's 10%. And then before October 1, the differential there is 112.5 million. And then we can apportion the same with respect to expenses, so that we can see from in the last quarter of the year, October 1 through December 31st, there's a $9 million controlling interest share of net income and a $1 million non-controlling interest 10% share of net income. And so we're told also in our note to the left that there were no dividends before or after the acquisition. We are just putting zeros in here so that it's clear for folks. And so based on the information that we just calculated, we can see what our worksheet entries are, and these show us the debit columns and the credit columns, and then the general ledger accounts that are involved. So we have a $9 million debit to income from SAP and a $9 million credit to the investment in SAP account. We have a $1 million debit to the non-controlling interest share, and then a $1 million to the non-controlling interest. Then we have sales of 112.5 million as a debit, because those were the pre-acquisition sales. We have a common stock debit for the pre-acquisition retained or common stock balance of 100 million, and then we have retained earnings balance debit of $90 million. The cost of sales is the same pre-acquisition cost of sales basis calculated as on sales, which results in a credit, and then we end up with a $225 million credit in the investment in SAP account and a non-controlling interest 10% share of that $225 million of $25 million. And so those are the worksheet entries that we would post as a result of the analysis we performed in the prior slide. And this just shows us what our worksheets would look like, and you recognize these, I'm sure, from prior readings and from prior examples where we've discussed. We have the POD ending year-end balances, we have SAP's year-end balances, and then we have the debit and credit adjusting entries, and all of that resulting together to get us a consolidated income statement and consolidated statement of retained earnings. And again, you'll recognize here that we have the balance sheet under the same scenario to get us to consolidated total assets of $793,875 in assets, and the same amount in liabilities and shareholders' equity. And so now let's talk a little bit about the sale of ownership interest. When an investor sells an ownership interest, we normally compute a gain or a loss on the sale as the difference between the sales proceeds and the carrying value of the investment interest sold. The carrying value of the investment should reflect the equity method when the investor is able to exercise significant influence over the investee. If the investor acquired its interest in several different purchases, the sales or the shares sold must be identified with particular acquisitions. And so in this example, we see where PAN owns 90% of SAG. PAN's 1112 $228K investment balance reflects SAG's underlying equity plus $18K of goodwill. During 2012, SAG reports $36K of income and pays $20K of dividends on July 1. PAN sells 10% interest on January 1 for $40K. And so under this scenario, we see that PAN still owns 80% of SAG, or still a controlling interest. And so we see that underneath here where we say before the sale, PAN's interest in SAG was 90, there was 10% interest sold, and so after the sale they owned 80%, and the investment account balance at 1/1 was $288K. And that's on PAN's books. And so if we look at this calculation from a T account perspective, right, and you all remember these T account looks, we see where the opening balance was a debit in the investment in SAG account on PAN's books of $288K. We see that we are told that we sold 10% of that sale, or 10% of that. So we sold 1/9. Right, 1/9 of the shares that we owned we sold, and so that's about 11%. And so the 11% of 288K gets us 32K that we're reducing our investment account for, and we're told that we got 16K in dividends. And the 16K comes because the dividends declared were 20K in dividends, and that was on 6/1, but it was after we had made our sale, so we only owned 80% of the stock at that point in time, so we only received 80% of the 20K in dividends. And so under the equity method we offset the investment account in SAG by the 80% of the 20K in dividends, or 16K, and then we're told that there's 36K in income, and so we pick up 80% of the 36K in income, and that becomes an increase in the investment in SAG account, so that by the time we take into account the opening balance, reduce the opening balance by the sale of our ownership interest, and reduce the opening balance by the receipt of dividends declared, and then increase the opening balance by the income associated with our 80% ownership of the organization, we ultimately come to a 12/31 balance of 268.8K. And so our entry to record our sale, and we're told that PAN sells their 10% interest in SAG on January 1 for $40K. We received $40K in cash. We reduce our investment in SAG by $32K, which we calculated on the previous slide, and we reduce the additional paid in capital for the differential. Note here that no gain or loss is recorded because we still maintain or retain control of SAG. Since PAN retains control, the sale of some shares is treated as an owner transaction. The difference impacts paid in capital. And then here, all we're simply doing is kind of following up what we talked about to talk about the what are the non-controlling interest calculations, and we see our balance that's given as of January 1. We add to that balance the income since January 1 for the 20% ownership. Since we own 80% the non-controlling interest and 20%, the non-controlling interests also are entitled to the 20% ownership of the dividends declared, which reduces their interest, and then the to get us to our balance at December 31 of 35.2K, which we reflect in the financial statements. And so again, here we just kind of can walk through the journal entries that reflect the calculations that we previously made, and we won't go through that detail in this discussion because of the we've done that several times now, but I trust that you're able to follow through the calculations and understand the debit and credit side of the entries and the general ledger accounts that are being involved. And again, these entries are made as debits or credits to our worksheet entries, which we then use to get to consolidated statements. And so if we talk about what our entries are, where we have an interim sale and there's a loss of control, they're similar steps, the only difference being that we bring the investment account up to date, recognizing the partial year's income is appropriate, which we did in our previous example. We determine the book value of the fraction of the investment sold. We compare that to the selling price in order to get to a gain or loss on the difference, which we did in our previous example. And the bigger difference being, because we're talking loss of control, the parent no longer consolidates the subsidiary because that relationship is no longer appropriate or justified. There is no parent-subsidiary relationship if we no longer maintain control over that. And because of that then, and because there's no consolidation, we will use either the equity or fair value cost method as appropriate to record these the transactions. And so in this section, we're really talking about changes in ownership interests from the subsidiary stock transactions. And subsidiary stock issuances provide a means of expanding the operations of a subsidiary through external financing. Both the expansion and the financing decisions are, of course, controlled by the parent. Parent management may decide to construct a new plant for the subsidiary and to finance the construction by advising the subsidiary to sell additional subsidiary stock to the parent. Subsidiary operations may also be expanded through the issuance of subsidiary stock to the public. A parent may even issue shares of one subsidiary to acquire another. In the case of a partially owned subsidiary, non-controlling stockholders may exercise their preemptive rights to subscribe to additional stock issuances in proportion to their holdings. And this, as you may recall from some of your finance classes, is a characteristic of common stock. Subsidiary operations may be curtailed if the parent management decides to have the subsidiary acquire its own shares. A parent investor's ownership in a subsidiary investee may change as a result of the subsidiary shares of additional shares or through subsidiary purchases of its own shares. The effect of such activities on the parent investor depends upon the price at which additional shares are sold or treasury stock is purchased, and on whether the parent is directly involved in transactions with the subsidiary. In accounting for an equity investment under a one-line consolidation, GAAP stipulates that transactions of an investee of a capital nature that affect the investor's share of stockholders' equity of the investee should be accounted for as if the investee were a consolidated subsidiary. So let's walk through an example now of the subsidiary stock transactions. So subsidiary actions could include increasing the parent's share where the sub issues additional shares to the parent or it reacquires shares from a non-controlling interest. They could decrease the parent's share by the sub issuing additional shares to non-controlling interest or the sub reacquires shares from parents. And then they could also not impact ownership. So the sub could issue stock to both the parent and the non-controlling interest, or the sub could issue a stock split or a stock dividend. So these are just all examples of the different types of actions available to the subsidiary. Obviously, the parent company, with the controlling interest, would be able to manipulate which ones of these actions took place. So in this example, we see that PUN owns 80% of SIT, which is acquired at 1/8. So again, we can back into the implied value as we've done numerous occasions before. By 180 divided by 0.8 gives us an implied value of strut of 225K and a book value of strut of 200K, which gives us excess or goodwill of 25K. SIT issued additional shares to PUN. So outstanding shares increased from 10K to 12K. PUN had owned 8K of the 10K stock previously, since we're told they had owned 80%, but now owns 10K of the 12K shares, or 83.33%. So PUN acquires additional shares directly from SIT at book value, so $40K or $20 per share. If PUN had paid $70, which is above the book value, or $30, which is below the book value, only the amount in the entry would change. The entry debit and credit side would not. And then the following analysis shows us the different amounts of goodwill which will be used in the consolidation worksheet. And so here we can see that SIT's equity was $200,000 before the sale. Then there was goodwill of $25K, which gave them a total value of $225K. PUN's investment in SIT, as we were told, at 80% was $180,000. So the $180,000 divided by the $225 gives the percentage of PUN's investment in the total value, which if applied to the equity of $200K gives us PUN's share of the book value of equity of 160%. We apply that same percentage to the goodwill, so we get a 20% share of goodwill, and to give us back to the total investment account balance of 180K. So goodwill may go up or down depending on the value PUN paid for the additional shares of SIT. And so at the bottom here, we're given an example of that, how the what the additional shares paid for SIT are. In one example, we sell at the book value of $40 per share. At another, we sell at greater than the book value for $70 per share, or at another, we sell for less than the book value for $30 a share. And you can see what happens as we work through each of those examples with respect to the new measure of goodwill and how it may go up or down, again, depending on the value that's paid for the additional shares of SIT. And so this gives us an example to walk through that deals with where the sub issues stock to outsiders. That is, they are not sold or issued to the parent company. So in this example, we still have PUN that owns 80% of SIT and it's acquired at 180. We can still get into the implied book value of SIT at 225, which gets us, based on the book value of SIT of 200, that there's excess goodwill of 25K. SIT then issues additional shares to outside entities. The outstanding shares increase from 10K to 12K. So PUN had owned 8K of the 10K share, or 80%, but now owns 8K of the 12K shares, and that's 66.67%. So they still have a controlling interest, they just don't have the same level of ownership that they had before. And so what we see in this calculation, that the PUN's measure of goodwill does not change when SIT issues the shares to outside entities, just the value of its investment in SIT's account. And so again, we see before the sale, SIT's equity was at 200K. We had goodwill of 225, which gave us a total value of 225K. PUN's investment was at 180K, so their share of the book value of equity was again the 160, and their share of the goodwill was 20K to give them a total value again of 180K. And then we see the examples below that talk about, well, if SIT were to sell these additional shares, or issue and sell these additional shares at 40K versus 70K, which is more than book value, versus 30K, which is less than book value, what would that do to the PUN's equity, share of equity under a 10-12 share? And you can see sold at book value, there's zero adjustment. Sold at greater than 70K, there's an upward investment account balance, or an adjustment upward of 20K. And sold at less than 30K, there's a downward adjustment to the investment account balance of 6.7K. But what we see constant there is that the goodwill balance doesn't change. And these again just give us what our adjusting entries would be under the various scenarios, whether it's at 40K, at 70K, or at 30K. And you can walk these back into the examples that we talked about, and you'll be able to see why there are debits and credits involving the investment and the additional paid-in capital accounts as appropriate. And so the acquisition of treasury stock by a subsidiary decreases the subsidiary equity and shares outstanding. If the subsidiary acquires treasury stock from non-controlling shareholders at book value, no change in the parent's share of subsidiary equity results, even though the parent's ownership percentage increases. A subsidiary's purchase of its own shares from non-controlling stockholders at an amount above or below book value decreases or increases the parent's share of subsidiary book value, and at the same time increases the parent's ownership percentage. The latter situation requires an entry on the parent's books to adjust the investment in subsidiary balance and to debit or credit additional paid-in capital for the difference in the parent's share of subsidiary book balance before and after the treasury stock transaction. And so here, let's assume that Sun Company is an 80% subsidiary of Penn. And that Sun has 10,000 shares of common stock outstanding on December 31, 2012. On January 1, 2013, Sun purchases 400 shares of its stock from non-controlling shareholders. Penn now owns 8K of Sun's 9.6K shares outstanding, or 83.33% of the shares. And so again, if we look at our table here, which summarizes the effect of the treasury stock acquisition on Penn's share of Sun's book value under three different assumptions regarding the purchase price of the treasury share. Penn's equity in Sun before the purchase of the 400 shares of treasury stock by Sun was 160K, and its ownership interest was 80%, as we see in the column or in the amounts above where we show before treasury stock. The purchase of the 400 treasury shares by Sun increases Penn's ownership percentage from 80% to 83.33%, regardless of the price paid by Sun. If Sun purchases the 400 shares at their $20 per share book value, Penn's share of Sun's equity remains at 160 as shown, even though its interest increases to 83.13%. This requires no adjustment. If Sun purchases the 400 shares of treasury stock at $30 per share, that is $30 per share or $12 above book value, we see that there's a $3.3K decrease from Sun's purchase price of treasury stock in excess of book values. If they're purchased at less than the book value of $6, then we see that an adjustment of 1.7K is needed. So GAAP prohibits the recognition of a gain or a loss from treasury stock transactions, but at the same time requires the equity method with amortization of any differences between the investment fair value and its underlying book value, unless the difference is due to an intangible asset with an intermediate life, such as goodwill. It should be understood, though, that frequent and insignificant treasury stock transactions by a subsidiary tend to be offsetting with respect to purchases and sales and do not require the adjustments illustrated. And this just simply provides us with the journal entries needed under the three different scenarios that we just spoke about. And so finally, we want to talk about what happens when the sub enters into stock splits or stock dividends. And we know that a subsidiary may issue stock dividends or stock splits. and that its impact is proportional, when this happens, is proportional in both controlling and non-controlling interests. So the percentage of ownership doesn't change because the controlling ownership receives its proportion of the stock dividend or stock split with respect to its proportionate share, and the same is true of the non-controlling interest. Stock dividends capitalize some of the subsidiary's retained earnings. And so having said that, we just want to keep in mind that although capitalization of retained earnings does not affect parent accounting, it does change the amounts of capital stock, additional paid-in capital, and retained earnings to be eliminated in consolidation. And so with this, we're through Chapter 8 of our text. And so I encourage you, some of this I understand can be very confusing when you're talking about parents and subsidiaries and controlling interest and non-controlling interest and treasury stock transactions or non-treasury stock transactions, pre-acquisition earnings, and I understand it can be very confusing, but I encourage you to go back and read the text very closely and walk through all of the examples that we've talked about so that you can get a good appreciation of this, because again, this course deals with contemporary issues in accounting, and these stock transactions, these controlling and non-controlling interests, the idea of parent and subsidiary and consolidations is a continuing evolving field, and it continues to be increasingly complex in an environment that is increasingly characterized by mergers, acquisitions, and combinations that require then, in many cases, these consolidations. So please go back and make sure that you've read this and are comfortable and familiar with it. And if not, do not hesitate to contact the facilitator of your course to get a better understanding. And thank you.